Hey everyone, I'm Bradford with a Penny Pincher's Guide to Personal Finance. We often see news stories talking about how some billionaire pays little to nothing in taxes. But I gotta tell you, 9 times out of 10, they aren't committing tax fraud. They're using incentives in our current tax structure to pay as little as possible. I'm gonna show you 7 ways that you can pay less in taxes like the rich do, including how you can turn your everyday expenses into tax deductions. Now, the first tip I want to talk to you about is going to be with retirement accounts. If you haven't already started contributing to retirement, now is the time to do it. Whether you're putting your money in a traditional 401k or a traditional IRA, both of these can significantly reduce your taxable income because they are both tax deferred methods. Now, the contribution limit for a traditional IRA is going to be up to $6,000 a calendar year if you're age 50 or younger, and up to $7,000 a year if you're age 50 or older. A traditional 401k does have higher contribution limits regardless of your age, is going to be $20,500 per calendar year. And how this works, for every dollar you put into one of these retirement account options, it's going to reduce your taxable income by that same dollar. And you're not going to pay any taxes on the money that is inside these accounts until you withdraw them when you hit retirement. Now, if maxing out either of these retirement options seems out of reach, then you might be interested in the Savers Credit, which rewards you just for putting any amount of money into an eligible retirement account if you make less than $34,000 a year if you're filing as single, or up to $68,000 a year if you're married filing jointly. This credit can give you thousands of dollars back as an incentive for you to invest in your own retirement. Now, tip 2 is going to be with a health savings account, or HSA. If you have a high deductible health plan, you could be eligible to open up a health savings account as a way to set aside money that is completely tax-free, both when you contribute it to your plan as well as you withdraw it as a distribution to be able to pay for your deductibles throughout the year. And this is a great way to shelter your money from taxes that you're going to use towards your health or that of your family. You can contribute up to $3,650 a year if you're single, or up to $7,300 a year if you have a family health plan. Now, tip 3 is going to be dealing with flexible spending arrangements, or FSAs. If you aren't eligible for an HSA, an FSA is a great alternative if your employer offers it. While it works in many ways similarly to an HSA, and that all of the money that you contribute is to be used on qualifying medical expenses, there are a few more other stipulations and restrictions on how you can use the money. You do have to set up all of your contributions to automatically be withdrawn from your paycheck every single month, and you are only able to contribute up to $2,750 per calendar year, and then you have to use all of that money in the same calendar year on qualifying medical expenses. Fortunately, the definition of qualified medical expenses is rather broad and gives you quite a bit of discretion on how you're going to actually use the money. But the main point is that you're able to tax shelter up to $3,000 a year if you plan ahead. And tip 4 is going to deal with tax loss harvesting. Tax loss harvesting is a strategy that a lot of large investment firms use with their clients to be able to offset the capital gains that they make throughout the year. Say if at the end of the year you have some investments that are underperforming, you might be better off to actually sell those investments to lock in a capital loss, which is able to offset the capital gains that you made with other investments that performed well. In this example, let's say we have stock A and B. Both at the very beginning, you invested $5,000. Now, stock A, you sold at the end of the year, and it had grown up to $10,000. Now, if you didn't do anything else, you're going to end up owing taxes on $5,000 in capital gains from stock A. But we have stock B in this example, which started out with the same $5,000, but over the past couple of years, it has gone all the way down to $3,000 and doesn't show any sort of signs of improving in the future. So in this example, you might want to sell stock B and lock in that $2,000 of a capital loss to be able to lower your taxable burden from $5,000 all the way down to $3,000 that you're paying capital gains taxes on. And you're able to take that money that was sold from stock B and to reinvest it into a better performing stock to be able to grow your money more over the long term. Tip 5 deals with furthering your education just by going back to school. The American Opportunity Credit, AOTC, or the Lifelong Learning Credit, LLC, are both credits that are eligible to you to help lower the cost of schooling. Now, the American Opportunity Credit can get you up to $2,500 back per year, but you are only able to use it while you are attending your first 4-year degree. Now, the Lifelong Learning Credit can get you up to $2,000 back in eligible education expenses, and that is regardless of what level of education you're pursuing, and you could potentially use this each and every year you are pursuing some sort of higher education to further your goals in life. So if you're currently in school or thinking about going back to school, these are 2 credits that you need to seriously look into to see if you qualify for, because then that's a couple $1,000s back in your pocket. Tip 6 is real estate. By far the biggest way that the rich are able to offset their income to pay as little as taxes as possible is by owning and investing in real estate. Even by just owning your own home, between depreciation and interest on your mortgage being tax deductible, you can significantly lower how much you pay in taxes every year. It's important to note that only just by owning your own home, you have to have a relatively expensive property to make it more worthwhile to take an itemized deduction as opposed to the standard deduction. Now, if you're single, that means your home is going to need to be worth approximately $350,000 to make itemizing your taxes be equivalent to taking the standard deduction, and up to $700,000 from the value of your home if you're married finally jointly to make itemizing your taxes with the depreciation schedule worth it. But if you start investing in real estate as a form of passive income, you're going to be able to use the depreciation and the interest on your mortgage to be able to write off the majority of the income that you generate, which means it's going to be largely tax-free. And tip 7 is to start a business. Whether you're starting a full-on business or just starting up a side hustle, this can be anything from as small as flipping items from garage sales and selling them on eBay, driving for Uber, or even starting up the next Apple in your garage. This is a way to be able to turn a lot of your everyday expenses, whether it's your internet or your phone bill, and turn them into business expenses, which are all tax deductible. Now, probably my favorite tax deduction when it comes to running and owning your own business is going to be with meals. Because of the 2017 tax cuts, all the way through the end of this year, you're able to write off up to 100% of any business meals that you have. After this year, it's going to go back to 50%. But even so, that means by taking your friend out for a meal and talking about your business and your business strategies and seeing if that's something they're interested in going into, that means you could have potentially your entire meal written off as a tax deduction because it is a qualifying business expense. Now, I do want to add the caveat that business taxes are significantly more complicated than just having a simple tax return that you file with your W-2 job. Understanding what you have to do with terms of capitalization rates, what you can depreciate in the current year, what has to be capitalized over a longer time period is pretty complicated, and it requires a significant amount of research on your own before you start doing it if you're going to be filing these taxes yourself. Or it's very easy to end up in hot water with the IRS because you didn't file the correct form, you filed it late, or you did it incorrectly, and that can get you hit with heavy fines and fees that are going to wash out any deductions that you made from a tax deductible expense. And then once you've started your business, if you're a sole proprietorship, you're going to need to become familiar with the Schedule C of the IRS Form 1040 to be able to log all of your expenses and all of your profits. Or if you start up a partnership or an LLC, you're going to need to become familiar with IRS Form 1065 to do the same thing, but with that taxable entity. I want to thank you for joining me today, and until next time, just remember to pinch a little.